Welcome to Research Recap on JP Morgan's Making Sense podcast channel. I'm Phoebe White, head of U.S. inflation strategy at JP Morgan, and today I'm joined by my colleague Mike Feroli, chief U.S. economist, and we're here to discuss takeaways from the April U.S. employment report as well as the path ahead for the economy and the Fed. Mike, thanks so much for joining.
Glad to be here.
So, Mike, last month we sat here talking about a report that seemed to be uniformly positive, and now we have a report where things were generally weak across the board. So what are your high-level takeaways?
Well, I'm not sure I'd say weaker. They were weaker, right? So this was still a good report. It was softer than anticipated and softer than the recent trends. But that's kind of what we and others had been hoping for because while the labor market, as Chair Powell would put it, has been coming into better balance, it's not totally in balance. It still looked a little hot. So I think all the cooling signs we saw today were welcome.
Right. Okay. And I guess you look at sort of 3-month and 6-month run rates on payrolls, both at 242,000. The diffusion index ticks up to 60.4.
Yeah, diffusion index is still in a kind of a normal territory, but the job growth did moderate. Some of that was a good chunk of it was in government, but in the private sector, you also saw some moderation in job growth. I think it's also important that the average work week, which, is always second fiddle to job growth, but it's still pretty important. Average work week did come down. So I think overall you're seeing, a moderation in broad measures of business labor demand.
Okay, so let's talk about that trend and sort of where we're headed. Last week, you revised up your GDP growth forecast from 1.5% to 2.5%. How do you think we're tracking for second quarter growth?
So I think we're tracking well. So I think even with the moderation we saw today in both hours worked and average hourly earnings, it still looks like nominal labor income is growing somewhere around 5%, which should be enough to support still, good consumer spending gains. And the consumer really has been, the bulwark of the economy here. So still feel pretty good with, obviously it's early in the quarter in terms of data, but we still feel pretty good with a number in that ballpark.
And in terms of potential sort of conflicting signals from different data reports, it seems like generally we had been seeing some signs of weakening across other data. We got JOLTS this week, openings keeps coming down, the ISM services numbers. But I think what's interesting is claims have been stuck at such a low level. Is there something different about this cycle, or do you think we will be seeing claims tick higher if things keep weakening?
It's interesting you mentioned the JOLTS report because within that report, what you see is that layoffs, which should correlate to some degree with claims, have also remained low, but that gross hiring has slowed. So I think what you're seeing is that businesses, while they aren't laying people off, they're just less enthusiastic about adding to headcount right now. And I think that's starting to show through a little bit in the net number of hires. I guess, another conflicting signal is earlier this week, we got a strong ECI, whereas now, particularly with the revisions, average hourly earnings are looking softer, and I think that's just one of those things, par for the course, which is you're going to get some conflicting signals here. And it's probably best to kind of average all of these when thinking about where wage growth is going.
So do you think even post-revisions, that bounce in first quarter is sort of a bump on this road to normalization? We also, I guess, got stronger unit labor cost data. So where do you think we're headed on the wage front?
It does look like we're still moderating. And again, I think the signal from, average hourly earnings, again, a year ago now is down to 3.9%. Three-month annualized also looks pretty soft. And then we had last week a softer signal on median usual weekly earnings in the first quarter. So when I kind of average all of those things together, I think wages do look like they're still moderating.
Okay, so let's talk about how the Fed is viewing inflation and maybe the risks to the outlook here. So at the meeting this week, we got some marginally hawkish changes to the statement and Powell's prepared remarks. But generally in the Q&A, he sounded pretty optimistic that inflation will be stepping down over the course of the year. So is there anything that surprised you from the Fed this week?
Not in a huge way, but I think you kind of alluded to the fact that the committee documents, which are the statement, and to some degree probably the prepared remarks, were more hawkish than the way Powell sounded. And Powell definitely, while those prepared remarks, for example, took out the mention of rates being at their peak for the cycle, Powell definitely leaned against the idea pretty hard that the Fed is contemplating hiking anytime soon.
Right. So instead, he laid out these potential paths as either holding off on rate cuts if inflation is surprised at the upside, or beginning to cut if we get that progress on inflation, or if we get unexpected weakening in labor markets. So which of those paths do you think is most likely?
I would think eventually, well,
I guess for the second half of the year, as we look.
So, well, I guess, to cut to the punchline, we're still looking for our first ease in July. And I think that would be a combination when we get there of the latter two paths, which is we do think they'll probably regain confidence that inflation's on the right path. And that, I think if you see the momentum in today's report carried through in the May and June reports, I think that would also give them, I wouldn't say concern about the labor market, but it would elevate the employment mandate in terms of its importance for policy going forward.
Right. And I guess, we should be seeing some progress by the time we get to that meeting. I guess some would say, we had these 3 stronger than expected inflation reports. Do we need to see, at least 3 weaker or at least, softening prints for the Fed to kind of get there and for the committee to feel comfortable? Do you think that we could see enough progress in 3 months?
I think it's possible. Certainly, I think today was the first post-May FOMC test, and I think we passed it. So we still have, 2 more jobs reports and then a couple CPIs as well. So I don't think it's solely the inflation numbers, but measures of inflation pressures such as wages, measures of inflation expectations. And we think again, it's not an easy path, but we do still think there's a path to get to a first ease in July. And as I said, we've only had 1 test so far, and we passed that 1 test, but there's a couple more to come. Right.
And if, I guess, we don't get there by July, of course, Powell was asked in the press conference about how much the election matters. Of course, he said Fed is independent. But how much do you think the election matters in their decision come September?
It's really hard to know. I think his answer was, of course he had to say it doesn't matter because I do really think he believes in his heart of hearts that the Fed is and should be a nonpartisan body. And I think the other easy thing to say is that, look, if we get, payrolls, the August payrolls in early September, if those show a big contraction in employment, they're going to cut in September, right? I think it becomes trickier and a harder call to say if it's a close call in September, does that factor in a little bit subconsciously in their thinking? And I think that's anyone's guess.
Right. Okay. And how about after the election, get to December onwards, how are you thinking about the path of cuts beyond kind of that first initial cut?
Yeah. So we think if we get back on track in terms of the disinflation like we were seeing in the second half of last year, much of which will come down to, as I think there was at least twice when Powell had to talk about shelter inflation. If that shelter inflation gets back on track and the disinflation process more generally comes together, we think we could see cuts at a pretty leisurely pace, perhaps once a quarter, though obviously a lot could change in the policy setting outside of monetary policy after the election, which could also change how we're thinking about things.
So after this morning's report, markets are back to pricing in nearly 2 full eases by the end of this year and 125 basis point of easing by the end of next year. So still a little less than our own baseline forecast. And with that, we still target 10-year yields moving lower over the balance of the year from just above 4.50 right now towards 4% by the end of the year. With that, let me close. Mike, thanks so much for your time today.
Thanks for having me.
And thanks to our listeners for tuning in. We hope you join us again next month. For more research insights, visit jpmorgan.com/research.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. This communication is provided for information purposes only. Please read JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2023, JP Morgan Chase & Co., all rights reserved.